Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where we look at the week's financial news that can be a bit confusing, misleading, and take you off course. And we hope to make it actionable, understandable, and clear. What a week, what a show. 3 excellent articles. At the top, Wall Street Journal. People are starting to look into gold. I found this to be fascinating. When markets get scary, mom and pop buy gold. Look into the data. And then billionaire investor Bill Ackman says he's shorting 30-year Treasury bills. Bom, bom, bom. One of our favorite prognosticators, Mr. Ackman. We'll look at what it means to short, what the 30-year is, and why he thinks that's remunerative for his clients and his account. And then in closing, another famous hedge fund type with a bad idea. Michael Burry of Big Short fame. You may have seen that movie, read the book, just bet $1.6 billion on a stock market crash. Ooh, scary. So let's start here at the top. A lot of fear, a lot of trepidation in these articles. Wall Street Journal, this is Hardika Singh. We featured a few from Hardika Singh, always a good read. When market gets scary, mom and pop buy gold. Swings in stocks and bonds have boosted the metal's popularity with ordinary investors. Article begins. Joe Susano lost thousands of dollars from his retirement account betting on biotech shares in early 2021. Now this 44-year-old integration engineer from Gloucester, Massachusetts is putting his money into an investment whose value is held up over the long run. Gold coins. I'm going to read this quote from him. I want you to listen to this and see what's going on in this man's heart and mind. He says, precious metals are kind of what just makes it so I can sleep at night, where I hold it and nobody can hurt me. Now, what other sleep aid does this remind you of? Where I can hold it and nobody can hurt me. If you guessed stuffed animal, you guessed rightly. This gentleman, Mr. Joe Susano, I always appreciate the candor these people agree to come on the Wall Street Journal. I think it takes a lot of courage to get on there and talk about why you believe about investing, mistakes you've made. But he's treating his investments like a stuffed animal. Be careful doing that. He later describes the fear he has. It's impossible that I'm going to end up in a bread line somewhere waiting for someone to drop something into my hand so I can eat. Again, he's being candid. He's telling us what exactly is going on in his heart. The article then continues about how gold has done good in some periods and bad in some periods. The article says, behind the recent allure of gold, many investors worry the stock market rally this year is concentrated in a handful of tech stocks. The banking crisis encouraged many of them to look at gold. And then this quote, by Scott Woolridge, who's 43. He says this, when you're buying metals and holding them, it doesn't matter whether the price goes up or down, you still feel pretty good about it. He continues, a downtick in the price of a precious metal means you have the opportunity to buy more, and an uptick means your net worth goes up, so it's a win-win. Now let's compliment Mr. Scott Woolridge on this quote before we cross-examine his thinking. I love the way he's thinking about investment. He's talking about gold, which I don't think you should invest in for a number of reasons. But I like how he thinks about it. It doesn't matter whether the price goes up or down. You still feel pretty good about it. And why do you think that is, listener? What does it take for someone to absorb volatility in an asset class and still feel good about that asset? I want you to think about it. What does it take for a bunch of volatility to hit a particular asset class? It could be anything. And for the investor in the asset class to still feel good about it. I've got my own theory. You may have your own as well. I think it takes understanding. I think you've got to know what you own and why. And to gold's credit, and these investors' credit, they know what gold is. They know what it is. It's a precious metal. So when volatility hits, they know they still have the same number of ounces of gold. So what if we could take this right thinking of gold and move it to the correct asset class for the long run, stocks. Then you'd really be cooking with gas. Because I think you should think about the stock market the exact same way. Doesn't matter if the value goes up or down. You have the same holdings. Mr. Sam Walton of Walmart fame, the gentleman who founded Walmart, where I currently buy my groceries, he was interviewed one time. Someone stuck a camera in his face and a microphone in the 1987 stock market crash. He said, "Hey, Mr. Walton, you're down, whatever it was, 30%. How do you feel about it?" Trying to get a reaction after Mr. Walton. And he looked and he said, "Well, I own the same thing." And that was it. Mr. Walton knew he was going to be able to walk into all of his stores the same day. He had the same number of shares of his holdings. That's the right attitude with investing. That's the attitude we should have. And what I worry about for the investing citizenry is this. There's a chart later in this article that talks about Americans' perception of the best long-term investment. And gold just crossed stocks. So more Americans think gold's a better place to be than stocks. And there are all sorts of reasons why that may be. You may rightly think, hey, the stock market's overpriced and gold's a good place to hang out, but over the long run, very, very rarely are gold investors rewarded. There are seasons, short seasons, where gold will outperform stocks. But if you have a 50-year vision for investing, and everyone should, even if you're 95 years old, you have 50. Warren Buffett's almost 95. He's got a 100-year vision of investing. You want to get on the right train. That's the stock train. The annual returns of stocks are vastly superior to gold. But what's the homework? I sometimes will have people comment to me, "Oh, Robert, index fund investing is so easy. There's nothing to it at all. How hard could it be?" Is that really what you do? Just sit around and tell people to invest in index funds all day? Well, kinda. But it ain't easy. If it was easy, investors would have good returns, and they don't. They do not, on average, have good returns. They do not get the market returns. So the homework you got to do is you got to have the same conviction about the stock market as these people do about gold. And the only way you're going to get it is if you pay the price of reading the books, listening to my podcast. Not a bad supplement, but understanding how the stock market works, understanding what a share of a company is, how a company makes money, what your ownership rights are, what an exchange-traded fund is, what a mutual fund is. All these things, to the degree you invest yourself in knowing and understanding these concepts, to that degree will you be able to withstand the volatility. And hopefully not end up like this Mr. Susanna, where you just want to give him a hug and a stuffed animal when he says, "It's impossible, I'm going to end up in a bread line somewhere where I can hold it and nobody can hurt me." We can relate to this, can't we? We're not so different from Mr. Susanna. He's being particularly candid, which we should respect him for, but in the long run, he's paying a very high price for those fears he has. That's a very expensive stuffed animal, throwing your money into gold. Incredible opportunity cost. For the last 10 years, gold's up 30%, the U.S. stock market's up 150%. You imagine being on the gold train the last decade? You're up 30%, and you watch the stock market get up 150%. You're not going to stick with your investing philosophy. No way. You're going to punt. Stick with the index fund, the market cap index fund. And now we transition to two billionaires doing silly things, which can happen. I'm reading a particular book called Titan about the great John D. Rockefeller, and it goes through his life, and it talks about the period of his life after his involvement in Standard Oil. He still owns all the shares and makes copious amounts of money, but he started investing. You know what kind of investor John D. Rockefeller was? The shrewd, calculated, cunning John D. Rockefeller. What kind of investor was he when he started his family office? A terrible one. And not just kind of bad. Awful. Awful. Just a bunch of zeros, not doing due diligence, doing deals with Baptists. Okay, that should be a rule in and of itself. But he, at his Baptist church, just throwing money at anyone who came up to him. And he's pretty smart. So we need to be careful. We don't just do what the billionaires do. They could lead you down a very bad road. So we have examples here. We're going to start with this Michael Burry, Big Short fame. He was the guy that really saw through the 2008 crisis and saw those mortgage bonds and shorted them, meaning he bet on their price going down and profited from it. Well, guess what? He's back. He's back. More predictions. And he, by the way, folks, I'll just give you a sneak preview. He makes these predictions all the time. So this CNN here in New York, Nicole Goodkind, Michael Burry, the Big Short investor, who became famous predicting the collapse of the housing market in 2008, has bet more than $1.6 billion on a Wall Street crash. This is insane. Robert Hunt's commentary. Burry is making bearish bets against the S&P 500 and NASDAQ 100, according to the SEC. Burry's fund, Scion Asset Management, bought $866 million in put options. That's the right to sell an asset at a particular price against a fund that tracks the S&P 500, and $739 million in put options against the fund that tracks the NASDAQ 100. Now get this, Burry is using more than 90% of his portfolio to bet on a market downturn. In moments like these, I think back to what the great Warren Buffett said. Don't risk what you have and what you need to get what you don't have and don't need. And that's what Mr. Michael Burry's doing. He'd do well to just he needs a stuffed animal, like that other guy in the Gold article. Just get a stuffed animal. This whatever is motivating this. So I'm sure he's done a lot of research, this Burry, but when you read something like this, you've got to have some context. Oh, in January, he tweeted a cryptic message, sell. But by the end of March, he backtracked, I was wrong to say sell. That was this year. Since he wrote that, the S&P 500 and NASDAQ have both notched big gains. They're up nearly 16% and 38% this year. And he told you to sell. So when really wealthy people with track records of success and a lot of intelligence tell you to do something, beware, beware, beware. They may not be telling you the truth. And in this case, they're not. And final article. Another billionaire investor, Bill Ackman, says he's shorting the 30-year Treasury bills. Billionaire investor Bill Ackman said he's bet against 30-year Treasuries as a hedge against the impact of long-term rates on stocks in a world with persistent 3% inflation. Now, we're going to have to enter the classroom here and really put our hats on. There's some terminology we're gonna really wade in here because we can do this. At the Robert Hunt Financial Market Update, the listener can do this. So, what is a 30-year Treasury? It's a bond. That's a promise from the federal government to pay the holder of that bond interest over a 30-year period at a fixed rate. So, for many of you who are in the interest rate world, you know this. Interest rates are going up. And they're going up a lot. And the 30-year interest rate on your mortgage, maybe close to 8%, which is just eye-watering. But on the 30-year interest rates for bonds, it's going to be a little less than that. It's about 4.38%. Well, what Bill Ackman is thinking is that as interest rates rise, when he gives you that quote, hey, he thinks 3% inflation. Remember, the federal government, the Reserve, not the federal government, the Federal Reserve has a 2% inflation target. So Bill Ackman is thinking, hey, the Federal Reserve is going to keep raising rates until they hit that 2% number. Their mandate, that 2% mandate that Jerome Powell, Federal Reserve Chair, always talks about. And because of that, I think, Bill Ackman says, I think the value of these bonds is going to go down because interest rates are going to go up. So he's shorting. Remember that short thing he's doing with options, which is the ability to purchase a particular date, just like Mr. Michael Burry was doing. So what in the world? Why is Bill Ackman not just keeping it simple, keeping his costs low, investing somewhat time horizon long? What's he doing? Doesn't he listen? I don't know, class. I just don't know if he's listening. One day maybe. But he sees this as a hedge. Now, he owns lots of stocks, and he owns lots of equity in various companies. So in his mind, hey, I'll hedge. I'll put on this bet. And if those interest rates keep going up, the value of my equity holdings will eventually go down, he says. Now Ackman's right, technically. And that's the most dangerous advice, is when intelligent people who are right say things like this. And he may be right for his portfolio, for his goals, for his strategy, for his needs, for his fund. But it ain't right for you, and it ain't right for me. So, why do we not need to hedge? Why aren't we doing what he's doing? Well, the Bill Ackmans of the world can't keep this stuff up. With any strategy, with any philosophy of investment, I like putting it through the test. Can you stick with this for 50 years? 50 years. Can you do that? Nah, he can't do that. He's going to be in and out of this trade 10 different times. Well, let's not let you and I get into this game, because there are going to be a whole lot of headlines from here on out as interest rates rise or stay high that are going to feel a little bit like this, where people are going to bet on the end. Because there's truth here, listener, there's truth. As interest rates rise, it sucks money out of the system. Why? If you're an investor, and I'm seeing this talking with clients, and you have a pool of cash, and you're thinking about, what should I do with this money? But you're getting a risk-free return in your money market fund of 5.25% at Vanguard, or you're looking at longer dated bonds, these 30-year bonds, you're saying, I can lock in 4.3. All of a sudden, that real estate deal, that stock you're going to buy, all of a sudden, those opportunities don't look as alluring. And so you're starting to see investors do that. We don't need to think like that, investor. We're going to keep those costs low, that investing simple, that time horizon long. With a long time horizon, you really shouldn't play the Federal Reserve games. They may lower rates in 18 months. They may keep them high for 36 months. I don't know. But I wouldn't want to bet on it. These folks are betting on it. Mr. Ackman, Mr. Burry making bets. I think it's important to follow these bets up to see how they did. Occasionally they're right. Most of the time they're not. Most of the time these bets fizzle out and you don't hear a whole lot about them. I'm glad for this writer in the previous article, Mr. Burry, Nicole Goodkind from CNN, went back and said, now wait just a second. Michael Burry told us to sell everything in January, and then he went back and said he made a mistake, and the stock market's up 36% on the NASDAQ and 8% on the... Whoa. Yeah, everybody loves to make the prediction. Everybody loves making that prediction. But when the time comes, very few people make good ones. So let's control what we can. You know what the very best thing you can do right now, amidst these higher interest rates, amidst the concentration in index funds, amidst geopolitical tensions? It's to keep those costs low, keep that investing simple, keep that time horizon long, because that, listeners, is what's going to give you the best shot on your investing journey. Until next time.